Hey traders, Nick here on Sunday night, preparing the strategic market update for week ending in 12/16. This is a monthly expiration week, so usually it makes the market nervous a little bit. All right, so first of all, let's say what happened last week. Nothing major. We had one red tick after a big rally. How do we know that? Look at the S&P right here. Huge rally and inside a channel. So we hit a descending channel. Naturally, we should pause. It would be abnormal to just bust through this. So a small dip is normal. Even if we have another 1 week or maybe 2 weeks red and give back some, it would be somewhat healthy to have the opportunity to build a better base and eventually break out of this range and challenge this one and repeat the same process. This is normal so far, without a new headline. Now, speaking of headlines, the emotional triggers could be Tuesday, I believe we have the CPI. The last 2 or 3 have been very, very, very violent. Some up, some down. So I'm not here to guess which way it's going to go. I would rather make money off of the reaction of the move, because guessing could pay you a lot, but it's a coin flip. I'm not a very good guesser. It's easier to make money off of other people's reactions. That's my message. Whatever happens, I'm going to try to make money off of it. Generally speaking, when we have events like these, I expect a sigh of relief after the fact. So if we fall into the events, I will try to catch the falling knife by taking a few positions that are bullish. Maybe the SPX, maybe the SPY, maybe stocks, I'm not sure. Maybe the IWM. Because I want to swing trade the relief rally after that. We will have a bounce after whatever drop we may get. So if we want to talk some specifics, we have the S&P. Let's talk about the S&P. It's not the SPX, but it is the S&P E-minis, the futures contract. It's pretty close to the SPX, should give you an idea. This is the short term. It's a 30-minute candle. So this shows us what happened Friday and a few days before that. And you can see we have a very tight situation. We have support that is trying to hold and resistance that's heavy. So we have sellers up here. So the lines that I would pay attention to is 40.50, give or take a few bucks, and 39.30. Those are the two first lines of defense. 40.50 is right here somewhere inside this cluster, and 39.30 is right here somewhere around this candle. And then we have 39.14, which are these, and below that we would have to look further back to find, because we had pretty crazy rallies. So it's normal that the markets are weak. If I look at it, like, it's easier to lose this floor and hit support. So maybe they fall, and if they do, I will be catching the knife somewhere around 3800, 3780. I will get long for a nice bounce. Let's see what happens. I'm not forecasting the drop, but I'm ready. Just like I'm ready if they take out the 40.50, 40.60, we may get to the 41.80, I think, whatever there is seller. Let's look at this one first, 41.10. Okay, so 2 sets of numbers. It tells you that we're in a tight range with a couple of lines that could accelerate the move in that direction. You should also prepare yourselves, because a lot of opinions are going to be on CNBC talking windbags. We have the CPI on Tuesday, we have the Fed event on Wednesday, and the Friday expiration for the monthly. The Fed is not likely to change its mind. If he doesn't raise lower than last time, I think the market will have a huge problem with it. They're expecting a lower raise. If it comes in at 50 instead of 75, that's probably what they're expecting. If it comes in lower than 50, they're going to freak out in a good way. Either way, I think they're going to overshoot in that direction, and I will try to make money off of it, because he's still saying he wants to be bad for the economy for a lot longer than he thought, but at a slower pace. And we misunderstood that message last time. He did not change his mind about raising rates. He just wants to do it a little bit slowly, more slowly than he thought, but to a longer term, to a higher degree. So he wants to be bad for longer than he thought, except he's going to slow down the pace with which he's going to be bad. So I think we misinterpreted. The market thought that he flipped or changed his decisions. Okay, so let's talk other markets a little bit. The Dow, the DIA, I shorted it for us at the top, and we got 1 week of weakness there. It's not the end of the world. Look at it, right? And I think the Nasdaq is kind of like the SPX inside of a descending channel, nothing crazy. The small caps probably will tell us the most honest story because they are a basket of 2,000 stocks. They don't have big companies yanking them around. So you see, they have a very, very flat bottom and a pretty flat top, except for that stupid little jaunt there. Let's ignore it. So on the small caps, if you want to use them as a gauge, 190 or higher, in fact, I'm going to put my alert here, 190 or higher is good news. We will take $10 immediately with that and then challenge this. So what is this? It's back from August. That would be huge. And a dip into the middle range, so say 172 to 175, 170, yeah, something like that. I think we'll have a lot of buyers because these are pretty harsh bounces on pretty scary times. So we'll see. Now, if the small caps lose the lows that they've just established, like 162, look out below. The trip lower could be pretty sizable. And then the market will drop quite a bit, and I will catch them like 10, maybe 20% lower. There are some doom and gloom sayers out there that are expecting this, but they have been expecting it for a while. I think we need something new in the headline, something like really nasty that we have not anticipated. Hopefully it doesn't come.